I think the gripe a lot of people have who attack IULs isn't at the actual policy, but it's at the representation or the claims
Right.
around the product, right? It's not the product. The product's fine. The product is what it is. It's just, it's a black and white thing. You can't say I like it or don't. This is what it is. Okay. You can, I mean, you know what I'm saying, right? It's kind of like, do you need
Correct.
it? Do you
Yeah.
don't need it? Right. It's just when, there's oftentimes a lot of misrepresentation and then, a kind of false claims around it. And, and it does sound enticing. You can make this sound really good, and for those who aren't familiar with it, it's really easy to buy one of these, and it may or may not be the best thing for your situation, right? And a lot of times they're often presented in a vacuum, right? Without knowing anything else about you
Right.
or what you have going on, it'll be presented as, a standalone thing, right?
Yeah, and it's all sort of compounded with the environment around which insurance is often sold. Some of the worst offenders of misrepresentation of this are some of the larger sort of multi-level marketing kind of pyramid sales style insurance independent agencies where, like most sort of multi-level marketing things, they're more focused on recruiting people under you to sell, because when you have folks under you selling, you get a cut of their commission. So they kind of promote the business and the opportunity as build your own business, be an entrepreneur, create wealth. It's less about the product being sold
Right.
and being an expert in the product. And it's more so on like build a business, recruit people under you, scale up, get people to sell, et cetera, et cetera. And often in many of these places, the only product they can sell is insurance. They don't have licenses to sell securities. They don't have licenses to give broader financial advice or do investment management. Like, they are clearly out to get people to buy insurance products.
Right.
Couple that with the incentive of the more you sell, the more you make. The more you recruit and have people under you sell, the more you make. Oftentimes, these multi-level marketing style places are framing themselves as opportunities for people who are marginalized in their socioeconomic background or otherwise not given a chance elsewhere, or, hey, change your life, come here, build a business, be an entrepreneur, etc. And they have minimal to no experience in financial services, especially something as complicated and multifaceted as index universal life insurance. Yet it's relatively easy to get a license to sell insurance at your state or multiple states, depending on what states you're operating in. You can go from zero experience ever in insurance or financial services, and within a month be up and selling index universal life. And there's really well-refined sales scripts and talking points. And to your point, IUL sounds amazing. It presents really well. It illustrates really well. Will it turn out like that? Maybe, maybe not. I think a lot of people, there's a lot of maintenance from the user, from the owner, with how you fund it, how you manage it. Pay attention to how the different allocations and indexes you're allocating money to perform and or change over time, because the insurance company can change some of the economics of the product over the course of the policy. You have to stay on top of it. You have to commit to fund it. And a lot of times, especially again with these multi-level marketing style places, they are pitching this to the masses, to the low income, to the middle income families, which I believe this is, we'll never know, because again, this is private information, these contracts, these policies. But I suspect a lot of people who buy this in the lower and lower to middle income ranges are going to end up more harmed by this than good. It's a major financial commitment. It's very complicated. People selling it often don't know really what it does, how it works. The people buying it know even less. So like,
Right.
I almost sort of feel like Chicken Little, but I feel like there's something really big brewing where there's going to be this sort of like large wave of IULs going sour on people. Now, again, a lot of it could be user error, not funding it accordingly or whatever. But you're almost set up to fail when you're pushing this on someone who's not educated in the product, who's low income, middle income. I can just see bad things happening. And that's sort of my like, guys, we as an industry kind of have to do something about this. And
Sure.
I feel like I'm, kind of yelling into the sky, and a lot of people aren't listening. Some are, but a lot aren't.
Yeah, and I think two key points, and I think this applies to almost everything in sort of retirement financial space, right? There's no free lunch, right? It's a common term in economics, right? So if somebody, I mean, just pass the smell test, right? You can't you can't be promised everything. And if it sounds too good to be true, say, okay, but where's the trade-off? Where's the like? There's got to be some catch. Everything has it. There's no
Correct.
free lunch, say it in economics. And then the other point, how I approach things, and this is a little bit, I don't like rules of thumb because everybody's situation is different. But I kind of put it in my head that like I like to keep things separate, right? If my goal is investments, then I'm going to focus on investments. If my goal is insurance, then I'm going to focus on insurance. And it's like a Swiss
Yeah.
Army knife, right? A Swiss Army knife is perfect in the right situation, but if you need a screwdriver, would you rather have a Swiss Army knife or a screwdriver? You want a screwdriver, right?
Correct.
I mean, they
Yeah.
both can do the job, but one is better, right?
Yep.
And so there are places where a Swiss Army knife is advantageous, right? Let's say you can't qualify for traditional long-term care insurance, and you do want to leave some sort of life insurance, and you want to create this Swiss Army knife and put it together. There's places for that, but you got to ask yourself, what tool do I need, and use the better tool, right? Rather than just start combining things because it's cool to have them all in one tool. And I know that's that's a kind of a strange analogy. That's how my brain works, but that's how I view it.
I think that's a perfect analogy. Now, I've said the same almost in rebuttal to agents who sell IUL as a Swiss Army knife. It does lots of things. Like, yes, a Swiss Army knife does lots of things, but the more things you try to do, the less proficient and efficient you are at each of those things. To your point, if I have to put together a large piece of IKEA furniture, will the screwdriver and my little Swiss Army knife work? Sure.
Right.
But if I have to put in like 87 screws, like I want a real screwdriver or a screw gun.
Right.
Same thing if a really large 6-inch diameter limb falls down in my driveway. Will the little 4-inch saw on the Swiss Army knife cut it? Yeah. I'll be there for 2 days. Like I'm going to want a real saw to do that, right? So
Exactly.
it does a lot of things, but it's not really great at any one of them because it's kind of diluting the benefit and value of each thing because it's doing so many things. Or at least I think that's a decent enough analogy to apply here.
Sure. Okay, so let's jump in and explain a little bit of the terms and the inner workings of IUL, just for those who maybe don't know too much about it. So, high level, you have term insurance and then you have permanent life insurance, right?
Yep.
Those are the kind of two branches, right? And we're going to head down this permanent life insurance path to where we have you got your whole life and your universal life, right? So maybe start there, whole life, universal life, and then trickle down to where we find IUL and how that plays in.
Yeah, so great high level summary within life insurance. There's two broad strokes. There's term and then there's permanent. Term you have for like, let's say 20 years, you have a fixed cost during those 20 years. At the end of 20 years, if you didn't die in the interim, like it's over. You get nothing back. You don't get a death benefit. You don't get a refund. It's just gone. That's relatively cheap and inexpensive because chances are, I think like 98% or something like that of term policies never actually pay out. There's a reason for that, obviously, because if you're buying it at 40 and it's a 20-year policy, chances are you're not dying before 60. Some people do, but as a whole, they don't. Permanent insurance is more expensive per dollar of death benefit because it is by definition supposed to be there as long as you live and will pay out when you die. So of course it's going to cost more to buy a unit of insurance because it will be paid out by the insurance company, assuming again you keep the policy in force all the while. So within that permanent category, there's two sort of sub definitions or subcategories. There's whole life, which has been around a really long time. That's the most or the least variable, the least unknowns. It's like I need, let's just say, $500,000 of death benefit to last my entire life. Now, technically, these policies end usually at like 120. So if you actually live beyond 120, like good for you, you won. They cash the policy out, and it's like it's over. You kind of get what the policy is worth at the time. But most people aren't going to make it to 120. So you'll get this guaranteed $500,000 death payout, regardless whether you die tomorrow or at 95 years old. But there's a cost. The premium's going to be whatever, X dollars per month or per year that you pay fixed for the rest of your life. That's the most plain vanilla sort of basic scenario. As long as you're making those payments in full and on time, you will have that $500,000 death benefit for whenever you die. Then there's universal life. Universal it's sold as more flexible, which it is, but flexibility, you can flip it around and say it's another way of the insurance company shifting some of the risk from themselves to you. Flexibility meaning you don't have to pay like whole life where you have, I'm just making this number up, $1,000 premium per year for the rest of your life. With universal life, you can pay more premium, you could pay less premium sometimes. And if you build up some of that cash value within the policy, you can be like, oh, you know what? I don't want to pay my premium this year. let me just, in effect, take some money out of the cash value and have that pay for the premium, so I'm not paying additional money out of pocket. That's the flexibility to it, and you can definitely do that. So that's the universal thing. Technically, universal is like just a 1-year renewable term policy where it's guaranteed to renew every year, and you just in effect keep rolling that, keeping that annual term policy every year. And because every year you get older, it costs more to have a year's worth of life insurance because you're statistically more likely to die the older you are versus the younger you are. So the cost per unit of insurance for that 1-year term goes up every year that you age, as it should in that case.
Right.
So that's universal in a nutshell, what that means. Now, within universal, there's kind of 3 subcategories. There's just what's called just regular universal life, where the interest you get on the cash value is some known fixed rate, could adjust every year. Let's say maybe it's currently paying 4%. I don't know, but it's a fixed rate of interest you get. There's variable universal, where you can actually invest your cash value in mutual fund like securities, like an S&P 500 account, where the cash value can go up or go down based on how those investments perform. Then there's indexed universal, which is what we're talking about. That's this sort of hybrid in between where it's not directly invested in the market in securities, but the interest you get is keyed off of what the return is of some index like the S&P 500, where you can get some, potentially all of the upside subject to like caps or whatever, but no downside. You'll never get negative interest in an index universal life. That's one of the main selling features, is your interest could be something positive, but never less than 0.
Right.
So for now. So
yeah. So we'll just stay on the investment aspect of the IUL policies, and we'll talk about some of the terms. Right. So you said, you'll never go below 0, so that you could call that the floor. If you hear the floor, that's what that would be. And also too, you mentioned there, so we have participation rate and a cap rate. Do you want to talk about those two, participation rate and cap rate?
Sure. So participation rate just simply means how much of the return of the underlying index will you actually participate in or get. So for example, if the underlying index is the S&P 500 and it goes up 10% for the year, and you have a 100% participation rate in your IUL, you will get 100% of that 10% gain in the S&P 500 credited to you as interest. The other common mechanism in there is called a cap, which means it's the maximum amount of interest you can get for a given year or 2 years or whatever your interest crediting period is. Usually these are 1 year, but they could be longer. So going back to that same example, let's assume you have 100% participation in the S&P 500, but a cap of 10%. Assume the S&P goes up 15% for the year. You'll participate in all 15%, but you'll get capped out at 10. You won't get more than 10% interest. Or if the S&P went up 8% for the year, you'll participate in all of that 8%, and you'll actually get 8% because that's below your cap of 10%, where you're kind of maxed out with what you can get.
Yeah, and this is it just goes back to trade-offs. This isn't a bad thing, right? Because you're assuming, well, I'm not going to lose money. So what's the trade-off for that? You're not going to get to participate in the highs, right? And that's a fair trade-off. It's just
correct. You're not getting the 20+% returns that the S&P had multiple years over the last handful of years. You're getting capped out at whatever the cap was. Maybe it was 10, maybe it was 11, maybe it was 12. It's somewhere around that range currently, but.
Yeah, and so you have to ask yourself, is that trade-off, is that what I want? And for some people, maybe that is what you want. You want that trade-off. You're just totally risk averse and whatever it might be. So I know with annuities, and I think it's true with IUL policies too, like the promo rates, right? Because these rates can be outlined in the initial prospectus of a policy, but they are subject to change. It usually takes several years before they can change it. Like it's fixed for a little while, I believe, right?
Depends on the carrier, depends on the policy. So contractually, once you enter what's called an interest crediting segment, like I said, these are usually 1 year. So you buy a policy today, you will know going into the next year what your cap rate is, what your participation rate is. The insurance company cannot change that during the course of that year. So fast forward to the end of the year, you look at what the S&P did during that year, and that will drive, like based on your participation rate cap rate, how much interest you get credited in your IUL. Now, going into the second year's interest crediting period, the insurance company can typically, like you said, maybe there's a, 2 year, 3 year, 5 year freeze on it. But usually once you enter a new interest crediting period, then the insurance company can change what the cap rate or participation rate is going into that next year. Now, in your policy, there will be a contractual minimum to it. So it might be like the insurance company can change a cap rate every year, but it can never be lower than whatever, 5%. Like they'll guarantee that up front. So yeah, maybe you get a 10% cap rate to start. Maybe it trickles down to 8 in a few years, but you'll know it'll never be less than 5% in this example I just made up.
Gotcha. Okay, so let's move on to the withdrawals or the loans, and I see this
Yep.
is often quote tax-free withdrawals, right? But there's again trade-offs and there's a catch to a lot of things here. So the withdrawals are really loans, unless you're taking out what is your basis, what the premiums you paid in. There's like those two categories there, but the tax-free aspect only applies to like I said, your premiums you put in, or if you take out a bunch of the cash balance, enough to keep the policy in place so you don't wreck it, and you repay it to yourself, then there's no tax consequences there. But I think that's often misunderstood as like you're kind of beating the system. I mean, it is tax deferral and there are tax advantages to this, but is it as good as it's marketed with the tax-free withdrawals, so to speak? Do you want to talk about that a little?
Maybe, maybe not. Time will tell, looking back, whether or not taking consistent large loans from a policy every year in retirement ended up working out in your favor or not. So, yeah, so it's true that there's two ways to get money out of an IUL or any permanent life insurance policy, basically. You can borrow against your cash value. We're using the cash value as collateral, and you are taking a loan from the insurance company. So they're lending you money. They have your policy, they hold your policy, they know what it's worth, they know the cash value. So if you ever like need to default on that loan and pay it back and don't, they can just simply in effect seize your cash value and pay themselves back from that. That's why it's a collateralized loan. The other option is simply to partially surrender, to actually take money out, distribute money out of your cash value, which you can do. From a tax perspective, you're allowed to take out up to the amount of your cumulative premium payments without it being taxable. If you take out more than what you've paid in total, then the additional amounts taken out are taxed as ordinary income. Now, people who sell IULs and sell them as a tool to borrow against, to get cash flow against, rightfully do not advocate taking actual distributions out of cash value. They advocate borrowing against it. Now, this is where the product gets technical and complicated, and I'm confident in saying 90+% of people who buy this don't really understand the nuance and potential risk involved in this. All the while, we've been discussing this as like an investment style account. Hey, you put money in, you can get some cap rate, some participation rate, but you'll never get less than zero. That's all true. That's just in reference to the cash value feature of it. This is still first and foremost a permanent life insurance policy. There are necessarily costs every year to pay for the life insurance that you have. And in the early years, there's additional upfront costs, often called things like policy issuance charge, premium charge, et cetera, where like first year costs can easily be 15 to 20% in these things when you add in those costs I just mentioned. And then costs do taper down over time, but the first few years, costs are quite thick. And so I'm trying not to dilute this too much, but the cost of insurance that you pay is a function of how much death benefit you have versus how much cash value there is. Because if you have, let's say, a nominally stated $500,000 death benefit, but you have $300,000 of cash value built up, if you were to die, your beneficiaries only get 500 grand. Technically, what the insurance company is doing is giving your beneficiaries your $300,000 of cash value that you built up, and then they're only kicking in 200 grand from their own coffers. That 200 grand is called the net amount at risk. And that 200 grand is the dollar amount on which you pay the cost of insurance. Because again, that's the insurance company's money you're actually playing with. The other 300 grand is yours in effect. So if you actually take money out of cash value, you're now increasing the net amount at risk, and you now are making the insurance company having to pay more if you die to pay out the death benefit. They're going to charge you more for that. The cost of insurance will apply to that larger net amount at risk. So worst case, if you actually take money out, you can drive this sort of like self-fulfilling downward spiral where you take money out, the cost of insurance gets larger. If you're not paying more money in, the cost of insurance comes out of cash value, further driving down cash value, further increasing the cost of insurance, et cetera. So that's where these things can get dicey. And I'm confident saying majority of people who buy them don't understand or appreciate that. They just view it as an investment account that some dude sold them. So that's why you want to take loans against it, because you're not actually depleting down cash value when you borrow against it. Mm-hmm. The tax-free claim is accurate because, and this isn't unique to life insurance, anytime you borrow money and go in debt, let's call it, that's not income. Like you're just taking on loans, whether you borrow money to buy a house from a mortgage, whether you borrow money from a credit card to buy dinner for $100, like the credit card company's advancing you $100 to pay for that dinner. That's not $100 of taxable income. Of course it's not. It's not income. It's debt. Borrowing against a life insurance policy is no different. Mm-hmm. So it's true that taking loans is not taxable, but there's an added cost. It is a loan. There is a cost of interest to it that the insurance company charges. Currently, it's around 5-ish%, depending on carrier. But that now is an additional cost of the policy. So on top of the cost of insurance and any other admin charge or other ongoing fees there might be, you now have, let's call it roughly 5% interest charge on the amount borrowed, further coming out of cash value, which again can potentially, in worst case, lead to this scenario where your cash value keeps ticking downward, the cost of insurance keeps going up, which makes cash value tick down faster. Mm-hmm. So anyway, can it work? Yes. This illustrates really well. The people who are the most sort of misrepresentative of this, we'll call IULs, like the $1 million baby policy. Like, hey, buy this on your kid, put in X amount of dollars for 10 years, sit back and wait, let the money just grow and compound within cash value. When the kid's 60, he or she can take out $100,000 a year in loans for the next 40 years, never have to pay it off because they'll say the policy will self-support itself and the cost of interest, which again can happen, but there's no guarantee. Maybe it won't. The interest rates on the loan can go up. There'll be contractual caps on how much interest the carrier can charge. But just because your loan's 5% now doesn't mean it won't be 6, 7, 8% interest some point down the road. Again, further kind of like eating into cash value if that interest charge gets too big. So a lot of moving parts, very complex. My ultimate angle is, can these things work as projected? 100% they can. Will they? I'm skeptical. No one can prove that the $1 million baby concept of buying an IUL, or even on yourself, not a baby, but like buying it at 40, funding it for 10 years. When you're 60, start taking out loans for 30 years. That's a 50-year transaction I just discussed. IUL only came into existence in 1997. There's not a single IUL that's more than, what's the math on that? 29 years old? 28, 29 years old? Yeah.
Interesting, yeah.
So there is no single case of someone having built up an IUL and then took large loans every year for 30, 40 years from it. It's just not possible. So now we're never going to know until 30, 40 years from now whether or not these things have indeed performed as expected with these large annual loans. For what it's worth, people who really know, in my opinion, really know IULs well and are really pragmatic and realistic about how they present them will say, no, you don't buy this with the expectation you're taking out big loans every year for 30, 40 years. Like David McKnight, for example. Hopefully he was okay with me dropping his name. Tremendous amount of respect for him. He goes about presenting and positioning and discussing IULs the correct way. Even he's like, he cringes. I'm paraphrasing, but he cringes when he sees people pitch these as takeout loans for every year in retirement. He's not okay with that. And I more align with him because I know he views these things more, again, pragmatically and academically and more realistically than a lot of people who sell them.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Katita, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.